Hello, welcome to this particular class. Today, I would want us to look at this particular important topic in financial management known as financial statements analysis. So if you're given financial statements, for instance, you have an income statement of a particular company, say for 2 consecutive years, income statements of a particular company for 2 consecutive years, we have 2018, 2019. How do you use those particular financial statements, income statements, to appraise and tell us the general progress of the company in terms of what you are measuring performance? So of course, it will be very important for you to calculate what we call ratios. So we must be good at calculating the profitability ratios. We must be good at calculating liquidity ratios, solvency ratios or gearing ratios, investor ratios, efficiency ratios, etc., etc., etc. I'll share my screen with you for you to be able to understand what I'm talking about. Now, ladies and gentlemen, when it comes, for instance, to financial performance profitability, these are the kind of ratios that we need to really understand how to capture them. So we have here the profitability ratios. So profitability ratios, the very first one here will be the gross profit margin. So we have gross profit margin. Gross profit margin, ladies and gentlemen, we normally take the gross profit divided by sales of the company times 100. Gross profit all over sales times what here? Times 100. So this is quite important for us to note that for gross profit margin, the firm that is doing well will be that firm whose gross profit margin increases with the time. Whose gross profit margin increases what here? With the time. Increases with the time. So gross profit margin should be increasing with the time. With the time. So ladies and gentlemen, remember that these are RCM online tutorials, video classes, and of course, you also sell books. Should you want our products, don't forget, our number is here. Our number is there. Great. 0719 525,000. That's our number. Get in touch with us today. I'm so sure we have got good products for you. Now, that is gross profit margin. Then we have got, ladies and gentlemen, we have the operating profit margin. Operating profit is profit before interest and what? Tax. Profit before interest and tax. So divide this by any margin is always divided down there in the denominator. We have what here? Sales. And then, ladies and gentlemen, we have what we call ROCE. ROCE is return on capital employed. Return on capital employed is exactly the same as what here? ROE. ROE is return on investment. ROE is return on investment. So should you be willing to get this particular ratio, ladies and gentlemen, should you be looking for this particular ratio, then what you need to do is to come and take the profit before interest and tax all over capital employed. All over capital employed times what here? Times 100 again. Times 100 again there. So then we have got this net asset turnover. Net assets turnover is also a profitability ratio. Profitability ratio. So the net assets turnover. As the name suggests here, of course, somebody will tell you that this net assets turnover formula, look at this. It's like net assets over turnover. Net assets over, no, we are supposed to turn it over. So it's supposed to be turnover, all over what here? Somebody, all over net assets. It's supposed to be turnover all over net assets. And then remember that turnover is the sales. Net assets is the capital employed. Net assets is the capital employed. Sales over capital employed. Sales over capital employed. So that is quite important. So let's look at an example. How do these things apply? How do they apply? How do they apply? So if you're given this kind of a question, if you're given this kind of a question, you can see we have profit before interest and tax of 10,200. We have interest there, we have tax there, we have profit after tax. Then we have share capital, we have reserves, we have loan liability. Loan liability. So they want us to give them Hassan's return on capital employed. Hassan's return on capital employed. So how do we get return on capital employed? So return on capital employed, which is our ROCE, our ROCE, ladies and gentlemen, here will be equal to, our ROCE, ladies and gentlemen, here will be equal to, our ROCE will be equal to, we have here, our ROCE will be equal to, we have here profit before interest and tax, all over capital employed. All over capital done what here? Employed. So capital employed is the same as net assets. Capital employed, ideally, we need to take the total assets of the firm. Capital employed. We are supposed to take the total assets of the firm minus the current liabilities. Total assets minus the current liabilities. So if you look at this question, ladies and gentlemen, if you look at this question that we have, ladies and gentlemen, if you look at the question that we have here, it will be quite hard for you to get what here, the total assets. You can't see total assets there, right? Also, you are not able to see your current liability. Then the easiest way for you to get this particular capital that has been employed, the easiest way for you to get this capital employed, remember, who are the providers of this capital employed? The providers of the capital employed, are the debt holders plus the equity holders. So the debt that you take plus what here somebody, the equity holders, these are the providers of the capital of a firm. So like in this particular case, my capital employed will be equal to, you can see we have debt of 6,900. We have debt of 6,900 plus the equity owners funds. Owners funds, you can see the share capital, you can see the reserves. So both of them are adding to 35,600. Both of them are adding to 35,600. When you add these two, then you should be able to get our capital employed, which will be 6,900 plus 35,600, which at the end of the day, ladies and gentlemen, will give us 42,500, which gives us 42,500, like that. So then come and pick the profit. Please, for return on capital employed, you should never pick profit after tax. It is operating profit. And our operating profit is profit before interest and tax. Is profit before interest and tax. So are you able to see this profit before interest and tax? Oh yes, up here. The profit before interest and tax is 10,200. All over the capital employed, which is 42,500. 42,500. Whatever I will get here, I would want to change it to percentage. Then this will be 10,200 divided by answer times 100, which will end up giving me 24%. So I hope that is clear. I hope that is clear. What I've done, I've taken here the profit before interest and tax, which is 10,200 divided by capital employed of 42,500. Change it to percentage, which gives me 24%, which gives me 24%. Thank you. So that is quite an important profitability measure. It's important that we need to learn how to calculate these ratios. So look at example 2. So example 2, they want us to calculate the following ratios for the years ending 31st May 2019 and 31st May 2018. The gross margin and the operating margin. The gross margin and the operating margin. So we start with the gross margin. How do we get gross margin? To get gross margin, ladies and gentlemen, normally we take gross profit. Normally we take gross profit all over sales. So we have the year 2018, the year 2019. They want us to do comparatives, 2018 and 2019. So ladies and gentlemen, if you look at the statements given here, 2018 is this one. Sales is the same as revenue. Sales is the same as revenue. And then you'll be able to see the gross profit for 2018 is 28,000. So I should take 28,000 divided by 45,000. So 28,000 divided by 45,000, which is the sales. I'm following this formula: gross profit over sales, gross profit over sales, gross profit over sales, gross profit over sales. So the gross profit here is 28,000 or 45,000. How about the year 2019? It will be 23,000 divided by 42,000. This will be 23,000 divided by 42,000 times 100. So ladies and gentlemen, if I do it this way, what am I going to get at the end of the day? What am I going to get at the end of the day? So we have 28,000 divided by 45 times 100 times 100, which gives me here quite a high one, 62.22%. 23 divided by 42 times 100. This gives me 54.76. So I can see my gross profit margin doing what? Reducing with the time. The gross profit margin of 2019 is smaller in comparison to the gross profit margin of 2018. So once we realize that, ladies and gentlemen, this thing is reducing, once we realize that GPM is reducing, gross profit margin is reducing, that is an indication of deteriorating performance, poor performance. Poor performance, that is what I write in my comments. Poor performance. Poor performance. Poor performance. Poor performance. Okay, so from there we look at the other one that they want us to calculate here. The other one which they want us to calculate here is the operating margin. How do we get operating margin? So operating margin is quite a simple one. Operating from the word operations, operating margin will not really disturb me at all. Operating margin, for me to get operating margin, I will take the operating profit, which is profit before interest and tax. Divide this by what here? By sales. Divide this by sales. So operating margin is operating profit over sales. The word margin means that we've got sales in the denominator. We've got sales in the denominator. So ladies and gentlemen, I would want to share my screen with you so that we can just fix these parameters. So you can see the operating profit for the year 2018 was 11,000. So in this case here, we have 2018, we have 2019. So operating profit, here we had 11,000, here we had 13,000. All over, you can see operating profit for the year 2019 is 13,000. So all over, the sales for 2018 is 45,000. For 2019, sales is 42,000. Again, I would want to convert these to percentages. So if I do that, then I'll end up getting 11,000 divided by 45,000 times 100, which gives me 24.44%, divided by 42, which gives me 30. So in terms of operating profit, ladies and gentlemen, it shows improvement. It shows that with the time we are improving. meaning that our gross profits in comparison to the sales, our GPM up there was showing a bad thing, but we made improvements in terms of operating expenses. So because our operating expenses here went down automatically, ladies and gentlemen, then our operating margin must have gone up. So we did quite a lot, significant savings in the form of what here? In form of operating expenses. So I hope that is okay, which means that now I can go ahead and look at the liquidity ratios. Liquidity ratios, ladies and gentlemen, what do we have under liquidity ratios, which you're supposed to understand? What do we have under liquidity ratios that we're supposed to understand? So we are through with the profitability ratios. So we go to the liquidity ratios. So liquidity ratios. So for liquidity ratios, the very first thing that I will always remember under liquidity, ladies and gentlemen, will be the word working capital. Working capital is key for me. So anytime anybody mentions, ladies and gentlemen, liquidity, always remember working capital. It's not a ratio really, but just remember working capital. So how do we get the working capital? To get the working capital, we normally take the current assets minus current liabilities. Anytime they want us to give them working capital, we normally take current assets minus current liabilities. Ladies and gentlemen, organizations that are struggling to meet their day-to-day obligations, to meet their current obligations, when creditors come to their office, there are organizations that always keep on cheating them that today the finance director is not there. He never appended his signature on your check. Today, this and this, because they are not able to meet their obligations as they fall due. Ladies and gentlemen, that is only possible when the current liabilities are higher than the current assets. Any organization that works with a negative working capital, ladies and gentlemen, is a firm that has got liquidity issues, is a firm with liquidity issues, Now, once I've been able to appreciate that, now I'll be able to look at the two types of liquidity ratios. The two types of liquidity ratios, what do we have? We have the current ratio. How do we get current ratio? We normally take current assets all over current liabilities. So please, you should write this in full. To get current ratio, we normally take current assets minus current liabilities. And if you recall very well, ladies and gentlemen, organizations that are doing well in terms of liquidity, of course, their current ratio must always be more than 1. And current ratio can only be more than 1 if the current assets, just like we said here, if the current assets are more than the current liabilities. And then from there, ladies and gentlemen, under liquidity, we know that we have got what we call the acid test ratio. The acid test ratio is the quick ratio. This is the quick ratio. And for us to be able to get the quick ratio, amongst these current assets that we have, there is an item that can't move very fast. There is an item here that has to go through quite a huge process for it to be able to generate liquidity cash for us. So that is the asset which we normally remove from the current assets, which is basically what here? Inventory. Closing inventory has to be subtracted from the current assets for us to remain with liquid assets. Those assets that just by a touch of a button, we can easily get what here? Money out of them. All over the denominator remains. All over the current what here? All over the current liabilities. All over the current what here? Liabilities. So ladies and gentlemen, if we are given this kind of a question. Yeah, me get a better one. Like now this one. Or rather, before when we go to it, let us just exhaust these formulas. We exhaust these formulas to make everything easy. Yeah, we go through these formulas. So we go to the working capital. Working capital. These working capital ratios, ladies and gentlemen, you will get some books calling them efficiency ratios. Efficiency ratios. Efficiency ratios. Under efficiency ratios, efficiency ratios, what we are calling the working capital ratios, very important ratios for us. Very important ratios for us. We'll start with inventory days. Inventory days. I like this. Inventory days. Inventory days. So, ladies and gentlemen, inventory days, what do I do to get inventory days? I will look at my inventory in the balance sheet. I know that inventory is normally found in the cost of sales. Cost of sales. Cost of sales, where we talk of opening inventory, add purchases, less closing inventory. So, ladies and gentlemen, here, inventory is normally found under what we call cost of sales times, don't multiply with 100, times 365, times 365. This is quite a very good efficiency ratio or a working capital ratio. Working capital. Ladies and gentlemen, remember, ideally, we should be able to convert our inventories to finished goods quite first. Our inventories here should be moving from the store quite first for us to say that we are efficient, for us to be able to open cash to go and finance our working capital. So the inventory days should not be growing. If you have a farm whose inventory days is growing, that farm automatically will get into financial difficulties. Will get into financial difficulties. So that is number one, inventory days. And then number two, ladies and gentlemen, we have a receivable days. Receivable days, we normally take the receivable. Of course, receivable normally comes from sales. Please don't use cost of sales here. Normally comes from sales. We sell goods on credit, and then we start receiving what here? We start receiving this money. We create a receivable asset times 365. 365. Ladies and gentlemen, also these receivable days are not very good. The more the receivable days you have, ladies and gentlemen, the poorer the performance. The poorer the performance. The more the receivable days, the poorer the performance. The poorer the performance. Because if you're taking too long to receive your money from your debtors, then automatically you will enter into a working capital problem. A working capital problem. These receivable days should be reducing. For as you become stable as an organization, an organization that does not need really to plead with their customers here to buy their goods, you should take these receivable days to almost zero, where you insist that buy goods from me on cash or year basis. But of course, you have to trade in. If you're a firm that is introducing, for example, a new product, you have really to give room for debt. But I'm saying that as you progress time-wise, we expect to be seeing your receivable days reducing for us to say that performance-wise, you are okay. Performance-wise, you are okay. Then now we have number three, payable days. So the payable days, you will come and take payable. Of course, payable has got everything to do with purchases. Payable, we purchase, payable. But if you look at the formula, normally, purchase is found under cost of sales. So we prefer using what here? Cost of sales, again, times what here? Times 365. Ladies and gentlemen, now look at this bad financial scenario. that for payables, we can only say that you are really improving your working capital management if the days you take to pay your creditors are increasing. The days you take to pay your creditors, if you're able to negotiate longer credit facilities with your suppliers, then that means good performance in terms of working capital management. In terms of working capital management, that means what here, good performance. Again, notably, ladies and gentlemen, always the payable days should be more than the receivable days. For me, I should be insisting that I get my money, the receivables, as fast as possible. But I should always endeavor, not in a bad way, I should always endeavor to delay my creditors, of course, with their agreement. You know, I'm using my position. I'm using my position as a big firm to negotiate with my suppliers. 3 months credit, 5 months credit. But of course, with receivables, again, I'll use my big name to tell these debtors of mine that if you don't pay me within, say, 10 days, I will not be advancing to you. So in short, ladies and gentlemen, when I'll be looking at performance appraisal, there is this one aspect. I would always expect to see receivable days being fewer than payable days. Payable days should always be more than receivable days. Thank you. Okay. Then, ladies and gentlemen, we have this concept of gearing, the solvency, the risk. Ladies and gentlemen, remember, when it comes to this risk, what kills most of these businesses out here, for sure, is high levels of gearing, is high levels of what here? Of debt. High levels of debt. High levels of what here? High levels of debt. High levels of debt. So whenever we are looking at solvency, we look at the debt to equity ratio, what we call the gearing ratio, the ability of us being able to meet the interest payments. So the interest cover becomes a great thing. So for us to understand this, we have these formulas, of which I've already given you the first one. The first one, which is quite important, is the gearing ratio, which basically is a debt to equity ratio, which basically is a debt to equity ratio, which basically is debt to what here? To equity ratio. So debt to equity ratio. So, ladies and gentlemen, for interest cover, remember we look at the operating profit. Interest cover, we look at the operating profit all over the interest. So anytime they want us to give them interest cover, we shall always be looking at the operating profit, which is PBIT, all over the interest expense per annum. And it should be the number of times. The more number of times the profit is able to cover the interest, the better the performance, But if the interest is more than the operating profit, then that is a highly geared organization. You are not running to anywhere. Or rather, you could be running fine, but to the wrong direction, wrong direction. So I would want us to look at this particular example. We are told here SAF, we are told SAF has experienced a period of rapid expansion in the last 6 months. Please underscore the words 6 months. During the launch of a new product on 1st July 2012. The following information is available from the management accounts of SAF. So you can see these are 6 months financial statements, 6 months financial metrics, 6 months only. So I can see inventory at the period end. I can see receivables at the period end. I can see cash and cash equivalent at the period end. I can see trade payables at the period end. I can see short-term borrowing at the period end. Then we have revenue for the period. Then you've got cost of sales for the period. So they want us to analyze the financial performance and working capital position of SAF, including the calculation of 5 relevant ratios. The first one that I'm able to see up there is the inventory period, inventory days, because I'm able to see inventory at period end. So I'll start by calculating the inventory days. That's quite easy. 5 ratios, I'm going to pick them very easily. So we start with inventory days. So inventory days, what do we have? We have inventory, and of course, it's not lost on me that inventory is normally found under cost of sales. Cost of sales within cost of sales times 365. Times 365. But now, ladies and gentlemen, this is the catchword. That the information we are given here is a 6 months information. 6 months information. But remember that the 365 days that you have here are for a whole year. A whole year. And that is why a good student will come and tell you, divide this by what? By 2. Divide that by 2. So if you take 365 divided by 2, if you take 365 divided by 2, that gives us 182.5. So consistently, I'll be using here 182.5. I hope you'll be able to see how I got that particular figure. So we have got 2 periods which are consecutive. So we have here for December, and then we have for what year? For June. So ladies and gentlemen, I'll do for June. I'll do for June. For June like this, and then I'll come and do for December. So for performance appraisal, I prefer starting with the initial period. So you can see in inventory days for the month of June, 02, or 460. So here we have 460. So come and divide this by the cost of sales, divide this by the cost of sales of which period? Cost of sales of June, 1450. So we have here 1450 times 182.5, like that. Okay, because of the 6 months. So we have 460 divided by 1450, which gives me approximately 58 days. How about for the period ending December? For the period ending December, ladies and gentlemen, for the period ending December, I can see inventories are 1220 vis-a-vis cost of sales of 2420. So we have here 1220 vis-a-vis cost of sales of 2420. Down here, you can see the cost of sales down here, times 365, times 182, 6 months, 0.5, which at the end of the day will give me 1220 divided by 2420 times 182.5, which will end up giving us 92, average 92 there. So ladies and gentlemen, in terms of performance, this doesn't really augur very well for us. This doesn't mirror a nice thing for us. You can see in this case here that inventory days have really increased. That growth rate of inventory days will choke you in terms of working capital management. That will choke you. This is a steep growth. So that is it for inventory days. Go and pick the next one. Remember, basically, they want us to build for them a working capital financial performance. So we are advising them. So from there, ladies and gentlemen, we have the receivable days, receivable at period end. So receivable days, I have my 790 there for June. For June, receivable Remember, formula basically, receivable days, formula basically will be the receivable days, receivable days, receivable comes from sales times 365, but because of the 6 months, now we have here 182.5. So receivable days for the month of June, I will look for the receivable asset. The receivable asset here is 790. So we have here 790. 790 all over the sales. Sales is the same as revenue. For June, you'll be able to see 2,000. Down here for June, you'll be able to see 2,000. So for June, we have 2,000 times 182.5. So we have 790 divided by 2,000 times 182.5, which at the end of the day gives me 72 days. So for the month of December, of course, I've already shown you how to interpret and of course, how to do the one of June. And to believe you'll be able to do the one of December for me and of course, interpret it appropriately. For receivable days, I can only say that my performance is good when receivable days are doing what here they are reducing. When they are reducing. But if they are growing again, I'm financing those people out there. I'm financing those people out there at my own peril. I'm sacrificing internally. And of course, there reaches a time when the way you sacrifice will become, in this case here, a monster. To reach a level you can't sustain that kind of financing other people, because at times you can go to your bank. Your bank, in this case here, tells you no to overdrafts. Again, why should I finance receivables out there interest-free? And then I go to borrow from the bank at an interest rate. So receivable days should always be reducing. Ladies and gentlemen, the other ratio that I'll be able to compute quite easily here, you can see the trade payables. You can see the trade payables. So trade payables, what do we have there? Trade payables, from trade payables, I will be able to calculate what we call the payable days. The payable days. The payable days. So payable days, to get the payable days, what do we have here? We have the payable divided by what here, somebody? Payable, of course, is found under cost of sales, divided by cost of sales, times, in this particular case, 182.5, times, in this particular case, 182.5. So then, ladies and gentlemen, what I will do, I will come here very fast. And pick for the month of June, for this period ending June, I'll come and pick the payables. So the payables, I have 580. The payables, I have 580 divided by cost of sales for the period ending in June. The cost of sales I can see 1450. The cost of sales I can see 1450. The cost of sales I can see 1450 times 182.5. So in this case here, what do we have? We have 580 divided by 1450 times 182.5, which at the end of the day gives me 70 what here? 73 days. So then I should be able to use the same method to calculate the payable days for December. If the payable days increase, of course, I'll be happy, so long as I'm within the confines of my credit period formal, which I was given officially. If I'm able to bargain with my creditors, I take longer, the better. So I expect you to calculate this one. And if possible, for the period ending December, once you get it, ladies and gentlemen, I expect you to make a comment. I expect you to make a comment there. Great. Okay, so we can look at the liquidity ratios. Liquidity ratios, the first one. Let's begin with the current ratio. So how do we get current ratio? To get current ratio, we normally look at the current assets all over the current what year? Liabilities. So current assets, what type of current assets do we have? Current assets, ladies and gentlemen, which we have here, current assets that we have here, ladies and gentlemen, you can see here they have listed them for us. Current assets, we have inventory, we have receivable, we have cash and cash equivalents, those three. So we want to do the ones of June. So June current assets will be 460, 460 plus 790, 460 plus 790 plus 790 plus 150 plus 150. Okay, so those are the current assets, the only current assets that we have. So I've taken the inventory, I've taken the receivable and the cash, all over current liabilities. So current liabilities, what do we have? Current liabilities, what do we have, ladies and gentlemen? Current liabilities, I can see trade payables and the short-term borrowing. So it will be 580 plus 0, basically. It will be 580 plus 0. So please go ahead and give us this particular parameter. Go ahead and give us this particular parameter. This particular parameter, we have 460 plus 790 plus 150 equals divided by 580, which gives me 2.4, 2.41. 2.41 is to 1. We normally say is to 1. 2.41 is to what here? Is to 1. Is to 1. So I expect you to do the same for the month ending December. So this is June. I expect you to do the same for the month ending December. And of course, we always prefer whenever our liquidity increases. Of course, not forever. Like now already the 2.4 is way too high. Also, we don't want to tie our funds. But generally, in terms of good performance, we prefer whenever we become more stable liquidity-wise. So from there, come and give us the quick ratio. So how do we get the quick ratio? It will be current assets all over what here? Current liabilities. Remember, current assets, you must deduct inventory, because quick ratio, inventories are not easy for you to convert them. Inventories are not easy for you to convert them to money. So in short, because they gave us a list, of the items. This is inventory. This represents receivables. This represents cash. What I'll do in this case here to make this easier, I'll only omit the inventory, because the inventory is always to be deducted. So you omit it. So basically here in terms of June, the current ratio will be 790 plus 150 all over the current liabilities, which are 580. So we have here 790 plus 150 equals divided by 580, which gives me 1.62. I'm so sure you'll be able to complete the others. Those are the 5 ratios which they expected us to do what here? To give them. So that is it. Thank you very much. I look now forward to solving a few past paper questions with you. Thank you.